Today was one of those weird market days where volume barely existed, but somehow the price action still managed to hand us something worth studying. Slow sessions can go either way, totally dead, or they give you one single move that reveals the whole story. And today leaned toward the second option. There's a setup I want to highlight because it didn't show up in the normal way. It failed. And sometimes a failed pattern is even more informative than a clean one. Let me clear all the noise from the chart so we can look at it clean. One of the most dependable continuation structures is the rising 3, falling 3 pattern. It doesn't need to be textbook. It almost never is. The idea is simply momentum push, a short pause of tiny candles, then a continuation in the original direction. That's the heartbeat of it. But today, we got the opposite storyline. Instead of following through lower like a falling 3 typically should, the price rejected the continuation level and broke upward. When a continuation setup gets invalidated like that, the market is basically saying, trend canceled. And that's information you want to pay attention to. When you start recognizing that rhythm, thrust, drift, continuation, or failed continuation, you'll see it constantly. And on low volume days, those failures can be even more dramatic. Speaking of volume, it was basically non-existent. But low volume is a double-edged blade. It can flush you down fast or allow price to float up with no resistance. Today gave us the float version. Weakness early, bounce back to the open, then they pinned it sideways into the holiday week. Now zoom out a bit. The S&P is pushing through levels that actually matter, and new data is hitting the market fast. This is where traders get stuck. They hold on to yesterday's story as if the market owes them consistency. It doesn't. The only real question you ask yourself each day is, does this idea still make sense with the newest data? Sometimes the answer is yes, other times the answer is absolutely not. If you're stubborn, the market will teach you the lesson the hard way. This is why I use the 12, 22, and 55 EMAs. 55 EMA shows whether institutional players are showing up or stepping back. 22 EMA shows who's calling the shots. Buyers or sellers, 12 EMA tells me whether swing trades have any probability at all. A few days ago, no swing setups. Bears had the wheel. Institutions were nowhere to be found. Today, totally different read, because conditions changed. That isn't changing your mind, that's adapting. Now, this doesn't magically guarantee we rip straight up. Resistance above is still real. We can stall, pull back, or chop endlessly. But here's the meaningful part. We reclaimed the trend line. We reclaimed the short-term highs. We closed above peak VWAP for the first time since the breakdown. That's a legitimate structural shift. Volatility is saying the same thing. The VIX is getting dismantled. No one is paying for premium. Move is falling too. When both drop together, the market is signaling that fear is drying up and liquidity is starting to come back. Sectors aren't falling apart. They're widening. Retail is breaking out. Big box stores are hitting new highs. That is not recession behavior. Biotech is waking up the second panic cools off. Tech isn't dead. It's rotating. Google, AVO, the mega caps, they're not acting like companies preparing for disaster. That doesn't mean the next 30 sessions are green, but it does mean the doom narrative isn't backed by actual price action. And here's where things get even more interesting. Both the S&P and NASDAQ are sitting right on top of their 100-day moving averages. S&P down about 4.5% from highs, NASDAQ down roughly 7.5%. More than 25% of NASDAQ stocks have RSIs below 30, heavy oversold reading. When that many names wash out at once, it usually means we're close to some type of stabilization zone. Combine that with the second highest put volume since 2005, you're looking at an extremely one-sided market, which tends to snap back. Zoom out to the bigger picture. Every major 5% pullback since 2009, outside of the clear bear markets, eventually turned into a buying opportunity. Headlines always sound catastrophic. Structure usually doesn't match the fear. And right now, big names are starting to look interesting. MasterCard oversold, Microsoft finally cooling off, Netflix resting at key levels, Robinhood dipping into early DCA territory. Oversold doesn't equal load the boat. But oversold high-quality names is exactly where you find asymmetric entries. Let's talk macro. Unemployment came in at 4.4%, the highest since 2021. That bumped the December 10th rate cut odds back up to about 70%. And here's the curveball. CPI, which was supposed to drop December 10th, got moved to December 18th after the Fed decision, which means the Fed will be making a call without seeing that data. So this week's releases, PPI, retail sales, jobless claims, sentiment, all carry more weight than usual. Thanksgiving week is slow, but the following week ramps up hard. Bitcoin, our risk-on thermometer, just decoupled from equities. Correlation flipped negative. Historically, when Bitcoin drops while becoming uncorrelated, stocks tend to be near local bottoms. Short-term structure for BTC is still bearish, lower highs, lower lows, and it needs to reclaim around 93K to shift momentum. But long-term on-chain data says, whenever the LT8-STH metric dips under 8, 2-month forward performance often averages around plus 40%. Not guaranteed, but worth noting. Volatility, we're back in contango. VIX stayed above 20 for a while, but is now sliding fast. The VIX to 3-month ratio needs to fall into the low 80s to confirm exhaustion. Until then, this is not a full send swing long environment. It's a be picky and find value environment. If you want to scan for opportunities, just ask your tools. Show me NASDAQ names with RSI under 30 right now. Then filter based on your risk and your system. Now let's jump to GX and momentum. We've had 4 green sessions in a row, more than 300 points higher on the S&P. Blew through the 50-day EMA at 6084, powered through the 6800 Gamma wall. Gamma for the 7000 strike is expanding like crazy, over 100K contracts today alone. That level has been the upside magnet for weeks. We're now inside the 6800-6900 dealer supply zone, same area that knocked us down in early October. This time the liquidity is thinner, so I'm expecting chop before the next leg. IWM ripped because Gamma flipped positive, but it slammed right into the massive 250 cluster. The move was way too quick. A pullback or cool-off wouldn't surprise me. Watch the 240 zone. That's the key test. Semiconductors are still lagging. NVIDIA bounced to just under 180, but it's not leading yet. It's under the 50-day and stuck in the 180 to 200 Gamma pocket. Buyers at 170, sellers overhead. VIX is in a controlled slide, sitting around 17. Still has a broader pattern of higher lows. If it bases here, be on alert. Tesla finally reclaimed its 50-day EMA after being stuck for almost a month. Gamma sits between 400 to 450. The stock has been trapped in the same big range since September. If it can break above 470 and defend it, then 500 becomes a realistic Gamma target. Until then, the range is the range. So here's the overarching message. The tone of the market is shifting. Volatility is fading. We reclaimed meaningful levels. Sectors are expanding, not collapsing. Biotech is rotating. Retail is ripping. Tech is stabilizing. Flows are leaning bullish. Bitcoin is acting as a risk-on tell. Oversold readings are stacking up. You don't need to predict the future. Just read the changing conditions honestly. Adapt your thesis when the evidence changes, and stop anchoring to last week's story. Because right now, the tape is telling a different story than the fear crowd, and the data backs it up.